Welcome to your deep dive. Today, we're looking at September 11th, 2025. A fascinating day, really. The U.S. stock market hit new records, but the story behind it is quite the paradox.
It really is. The main driver seemed to be bad news, which somehow got investors excited about potential Federal Reserve rate cuts.
Exactly. And at the same time, you had these huge company-specific events creating massive winners and, well, massive losers, too.
Definitely a day of contrasts.
So our mission for you today is to unpack these conflicting signals, pull out the most interesting bits, and give you the key insights. Let's get into it.
Yeah, and what's really striking is just how fixated the market is on the Fed right now. We saw a little hesitation early on. There was that headline CPI report.
Right, the inflation number.
Yeah, it ticked up 0.4%, just a bit hotter than the 0.3% people expected.
Okay.
But the core CPI, the one that strips out food and energy, that actually came in exactly as forecast. So that calmed things down a bit.
But that wasn't the main event, was it?
No, not really. The real turning point came with the weekly jobless claims.
Yeah, yes. And usually high jobless claims are bad news, right? Signals trouble.
Typically, yes. But they spike pretty dramatically up to 263,000. That's a big jump, 27,000 more than the week before.
Wow, highest in nearly 4 years, I read.
That's right. And investors, well, they didn't see economic distress. They saw it as proof, basically, that the Fed now absolutely has to cut interest rates.
So bad news for the economy became good news for the market. Classic.
Exactly. The bad news is good news playbook in full effect. And suddenly, the odds of a rate cut next week jumped to, what was it, 94%?
Yeah, 94% chance of a quarter point cut. And that optimism sent the S&P 500 to another all-time high, third day running.
NASDAQ did well, too. But, it's interesting. If you looked under the surface back on Wednesday, the market internals weren't quite as rosy.
What do you mean?
Well, declining stocks actually outnumbered advancing ones. It suggests maybe the rally wasn't that broad, perhaps driven by just a few mega-cap names.
A potential divergence there. That's important for you to note. What about the bond market? Did it agree?
It seemed to. The 10-year Treasury yield, which is, a key indicator, stayed pretty stable. That fits with the view that the Fed is likely to ease policy lower rates.
Okay, so the macro picture is all about the Fed. But let's talk about those individual company stories, because some were wild. Open Door Technologies.
Oh, yeah, up over 76%. 76.
Incredible. That was on news of a new CEO coming in from Shopify, Kasnajation, and a big $40 million insider investment. Strong signal.
Huge signal. And then you had Warner Bros. Discovery jumping over 26%.
Right, merger talk. Paramount Skydance, backed by the Ellisons, potentially bidding for the whole company.
Yeah, that points to maybe a new wave of media consolidation. Everyone's trying to bulk up with content for streaming.
But it wasn't all good news. We saw the opposite happen too, right? The dilution dilemma.
Exactly. Look at Enovix and Avidity Biosciences, both down sharply, around 12%.
And why? They announced plans to raise capital.
Correct. Convertible note stock offerings. But crucially, without major positive news attached, it's like the market punished them for needing cash.
Which is such a contrast to, say, Maze Therapeutics.
Perfect example. Maze also raised money, $150 million, but they did it alongside releasing fantastic clinical trial results. And their stock soared over 53%.
So the context is everything. Raising money to fuel success is rewarded. Raising money without that clear, positive story, not so much.
Precisely. It shows how critical the narrative is. Oh, and we also saw that speculative bubble burst with QMMM holding.
Right, down over 30% after that huge run-up tied to some crypto pivot. Back down to earth.
A very quick trip back down, yes.
Were there any broader industry things playing out? I know Oracle's recent AI success has had ripples.
Definitely. The Oracle effect, as some call it, their reported big deal with OpenAI, like $300 billion, is boosting not just other tech like NVIDIA, but even utilities.
Utilities, why?
Because all those AI data centers need massive amounts of power. So companies like Vistra Energy, Constellation Energy, they're seeing interest. It shows how far AI's impact reaches.
Fascinating. Okay, so let's synthesize this for everyone listening. September 11th, 2025, a market totally focused on the Fed, turning bad economic data into good news for stocks, but with huge volatility underneath, driven by company specifics.
That sums it up well. So key takeaways for you. 1, the Fed is absolutely central to market sentiment right now. 2, catalysts like news or trial results are driving huge individual stock moves.
And 3, how companies raise money matters. Dilution gets punished unless it's clearly tied to good news or success.
Exactly. So what should you be watching now?
Well, definitely the big U.S. jobs report coming out on Friday. That'll give a fuller picture of the labor market.
And then, of course, the main event,
Yeah.
the Federal Reserve's FOMC meeting next week. The actual rate decision, and maybe more importantly, Chair Powell's tone.
Right. That could still shift things. Any surprises there could really change the market direction.
Yeah, doubt.
Today really highlights how ingrained that idea of the Fed put is this belief the Fed will always step in. Investors seem almost programmed to buy on any hint of easing.
It's a powerful force.
It is, and it leaves you with a question, doesn't it? How long can this dynamic last, where bad news is just automatically good news for asset prices? What happens if eventually the bad news is just bad news? Something for you to think about.